mean, the tragedy of dark pools is their name. I mean, whoever invented the name dark pools ought to be shocked, because you see something that says it's a dark pool. So the last thing you want to do is to go into it, and obviously it's a red flag to any regulator. Look, liquidity is the lifeblood of the financial markets, and liquidity is super important in terms of reducing volatility and helping the process of intermediation, people who want to buy things and people who want to sell things. And it's really, really important that we facilitate liquidity in a way that makes the intermediation process as efficient as possible. And that was the original design intention behind the dark pools, was to facilitate liquidity so that people who really had large transactions that they wanted to do weren't constrained by the relative illiquidity of the more transparent market, let me put it that way, and weren't acting against their own self-interest by effectively declaring what it is they wanted to do. So I think it had a noble intention, it had a terrible branding. I think that those dark pools did get they didn't fulfill their real purpose, in the sense that the liquidity in those dark pools eroded to the point where you weren't really able to execute large trades in a dark pool. There was a convergence between the liquidity in the public market and the liquidity in the dark pools. And clearly the liquidity in the dark pools also got abused by people who behaved in a certain predatory way with certain kinds of flows. So it's no secret that some high-frequency traders would take advantage of the relative information gap that retail investors had in the market by picking them off in, through that process. So it was a good idea. There were some issues. They do need to get cleaned up. It does raise the whole issue about high-frequency trading. And I think if you want to create a level playing field, then to me there's one obvious thing that you should do. I mean, high-frequency trading in and of itself is not a bad thing, because the high-frequency traders are adding liquidity, albeit temporary liquidity, to the marketplace. They don't really add long-term liquidity to the marketplace, but they add short-term liquidity on a consistent basis. Effectively, it's long-term liquidity. But really what you need to do, they compete by being quicker to the market than anyone else. And if you really want to make it a level playing field, then actually you'd create a speed limit so that everyone accessed the market at exactly the same speed. To me, that would be fair.